Subscribe to the channel and press the bell icon to never miss any updates.
Well, there are many investors who are confused about the expense ratios and the fee structure of mutual funds. But don't worry, we are going to cover each and everything that you need to understand about the expense ratios and fee structure in mutual funds. Hey everyone, this is Anuj Vohra, and in today's podcast we are going to talk about how expense ratio works in mutual funds and how much you pay for the asset management of your money. So without any further ado, let's get started. So first thing first, that in the previous podcast that we understood that why it is so important to have a proper fund manager. So if you don't have a proper fund manager, then there are chances that you may not manage to beat the benchmark, which is Nifty 50 or Dow Jones Industrial Averages. So it is important to beat the benchmark, and that is why you need to have a fund manager having a good track record so he can manage to beat the benchmark, right? So now let us go with that flow. Now we are talking about fund manager. Now the who to whom we pay fees. The simple answer is fund manager and distributors. But before going ahead, let me tell you why you have to pay fees. Now basically, when you invest in mutual funds, your objective is to make more returns. Now obviously there are chances that if you are investing in arbitrage funds, liquid funds, or any kind of other debt funds, your approach towards investment is conservative. Now you are not expecting much return because you are in extremely safer place. But here, if we talk about equity mutual funds, you are expecting more than 10, 12, 15% return. So is it that easy to generate 12 to 15% return? It is not. So that is why the task of fund manager is to beat the benchmark. The fund manager offers you that if you invest in any fund, then you can expect 12, 14, 15% return based on the track record of fund manager. And as the fund manager has been delivering returns to you, you have to pay something directly or indirectly to the fund manager or asset management company. The small portion you give indirectly to AMC and the AMC give to the fund manager and distributor is called expense ratio. Normally the expense ratio of equity mutual funds are from 0.5% to 2% normally in India. Alright, so now why fund manager and distributor? Now there are two reasons. Now the first reason is the fund manager has a team. There are 10, 12, 15 people in the team who buy and sell stocks in the portfolio, and now the portfolio is so big, so that is why it is essential to have a team, and the management of thousands of crores of rupees is not that easy. That is why it is extremely important to have a team. So you pay expense ratio for that. On the other hand, if you are investing with a regular plan, and that means that you have a distributor, you have a mutual fund agent and mutual fund distributor, you have to pay something to them also. So there are some charges like 0.5 to nearly 1% you pay to the mutual fund distributor, because that person guided you to invest in that particular fund, and this is how the mutual fund distributor or mutual fund agent earns money. Now, while investing in equity mutual funds, there are two ways you can invest. The first way is direct investing, and the second is regular investing. In direct investing, the expense ratios are very less because you are investing directly from either the website of AMC or any third party application in which there is no distributor or mutual fund agent, so you don't have to pay a small portion of percentage to him. So that is why you manage to buy mutual funds at cheaper rate, because the expense ratio in direct plans are very less. Let's say if you are investing in any X fund, the expense ratio in regular plan would be assuming that it is 2%, and if we talk about the direct plan, it would be only 1.2%. so there is a huge difference of 0.8%. and if you think that 0.8% is just a small difference, and if you think for the long term perspective for 10 15 18 10 15 20 years of period, it makes a big difference. So in direct investing, if you are going with different kind of applications, mobile application, websites, and the platforms that are developed by the investment company or asset management company itself, then you don't have to pay much expense ratio. But if we talk about the regular plan, you have to pay a slightly higher expense ratio compared to the one who is investing with direct plan. Earlier I talked that you pay expense ratio indirectly to the investment company, or I should say asset management company, and here is how. Let's say you invest 100,000 rupees and the expense ratio is 2%. That doesn't mean you are paying 2,000 rupees from your investment directly to the AMC. It is not like that. You pay expense ratio indirectly to the AMC, and here is how. As you have invested 100,000 rupees in a mutual fund, let's say if you are investing in, here we are talking about equity mutual funds. So in the long run, let's say after 1-2 year and 4 to 5 years of period, you will definitely make profits, because the equity markets in the long run always perform well. So let's say if you are getting 12% return after 5 years of investment period, then here is what you need to consider. If the expense ratio of that particular fund was only 1% instead of 2%, your return would be 13%, not 12%. This is how expense ratio works. You will not see that you are paying to the asset management company, but in the long run you pay a lot money to the asset management company, because the fund manager and the team and the distributor have been helping you to achieve these kind of numbers, and this is why you pay expense ratio, and this is how the expense ratio works. Similarly, if there is a fund has been delivering 15% return and the expense ratio is 2.5%, now you may think that 2.5% is huge expense ratio and it is better not to invest, not to give such huge money to the investment company. But if you think practically, where will you get 15% return? Well, there are very few funds who offer 15% return, so what's the problem to give 2.5% expense ratio? But let's say if you think practically, that if you just consider 1% expense ratio instead of 2.5%, your returns would be 16.5%. Yes, the same thing you can do by investing directly, but you need to have a proper knowledge before direct investing. Most people make mistakes while direct investing, well, with direct mutual fund plans, and they just focus on 3 to 4 years of returns, and they don't check asset allocation, the track record of fund manager, and so many things, and they make mistakes. That is why I would recommend that even if you want to go with direct mutual fund plans, always consult an expert regarding if the fund is good for you or not. Here I would like to add one more point, is that if the mutual fund in which you have invested is offering 14, 15, 16% of return, and the expense ratio is 2 to 2.5%, and it's a regular plan, then don't worry, you should focus on investing. You should not look at the expense ratio, because your fund has been delivering outstanding return. Trust me, the fund is performing really well, and you do not have to look at the expense ratio. So during such kind of circumstances, you should avoid looking at the expense ratio, because the performance is extremely well. Another thing, if you are a fan of passive investing, that means if you are investing in index funds, if you love investing in index fund, and if you just want to get return what the index has been delivering, then index fund offers the minimum expense ratio in mutual funds. So if any active mutual funds, any active equity mutual funds offer you 2% expense ratio, and if we talk about the index fund, the expense ratio of index fund would be only 0.3 to 0.4%. So there is a massive difference you can see in the expense ratio of actively managed mutual funds and passively managed mutual fund, which is index funds. So if you are good, if you are comfortable investing in index funds, and make sure that your returns would be lower, because you are investing in index, your aim is not to beat the benchmark but to meet the benchmark. So this is what you need to consider, whether you should go with actively managed mutual funds where you can beat the benchmark, or you want to go with passively managed mutual funds where the objective is to reach at the benchmark, not to beat the benchmark. So this is what you need to understand about the expense ratios in mutual funds.